everyone, and thank you for joining us today for another OIC webinar presentation. My name is Mat Cashman, and I am Principal of Investor Education at OCC, as well as an Options Industry Council instructor. I will be giving today's presentation on Demystifying the Greeks. Just to give you a quick background on myself, I started trading in 1999. I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Pretty quickly after that, I moved to London and traded interest rate options there on the Bund, Babel, and Schatz, the German bonds, and eventually moved back stateside where I started and ran an index options market making business for the better part of about a decade in Chicago, again on the CBOE floor. Currently, I work at the OCC, helping individuals and investors to better understand both the risks and the benefits of exchange-traded options through efforts like our webinar today. Now, we always include a disclaimer to make the lawyers happy. Options involve risks. They're not suitable for everyone. They're complicated investment strategies. Any strategy discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes, should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance is always not a guarantee of future results, not indicative of future results. One other bit of housekeeping that is a little bit new, these are the following trademarks, logos, and service marks that you're going to see during the presentation. They are wholly owned by the Options Clearing Corporation. Again, you will see them used throughout the presentation today. I'm going to give you a little bit of background on the OIC to start with. The Options Industry Council, or the OIC, is the educational arm of our parent company, the Options Clearing Corporation, which is the largest clearing corporation of equity and index exchange traded options in the United States. OIC started out as a collective in 1992 to better educate the public as to the risks and benefits of exchange-traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, optionseducation.org, which you can see right here. There you'll find online courses, podcasts, videos, and webinars like the one we're doing today. A side note, today's webinar will be taped and on the website probably a couple of days after we're done with it today. So we are able to provide these services free of charge to the public because we are fully funded by our parent company, the OCC. Now, I work in a division of the OIC referred to as the Investor Services Desk or the Investor Education Desk, where I sit with 3 other colleagues. You can send us emails here at options@theocc.com. You will get a response from an actual human being with actual options trading experience. This is another free service that we extend to the public as well. It's important to note we are not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do, and what we really love to do, is help with general questions about options, optionality, and theoretical knowledge surrounding the options ecosystem. Amongst the 4 of us that sit on the Investor Education Desk at the OIC, we have over 100 years of industry experience surrounding options, and we are always happy to help in whatever way we can to further advance your understanding of options and how to responsibly use them in your investing. Today, I'm very fortunate to have 2 of my colleagues that sit on the desk with me handling the Q&A portion of our webinar. Please say hello to Mark and Ken behind the scenes. They'll be answering your questions live on the chat during my presentation, and provided we have enough time and I don't yammer on too long about the Greeks, we will have a Q&A at the end that they will be facilitating as well. So let's dive right in. What you're looking at now is a graph of the annual options volume from 2000 to 2021, divided up by year, obviously. We really consider this to be the modern era of options trading, and it encompasses the advent of high-frequency trading. And as you can see, there has been an absolute explosion of interest and volume over the last 2 years, much of it coming from the last 20 years is really focused in those last 2 years. 2008, I remember very vividly, I was trading index options, the CBOE. I remember seeing volume numbers that really made my head spin. That was the first year that they made a really new high. 2011 was obviously the advent of the sovereign debt crisis across the globe, and likewise, that set another volume milestone, followed by 2018, when the OCC cleared a record 5.2 billion contracts of exchange-traded options. But we have never before witnessed the explosion that we've seen over the last 2 years, obviously brought on by many factors, including sustained volatility of equity markets throughout the COVID-19 pandemic across the globe. What I think about and what I really look at when I see this graph is I think about all of the people that are involved over the last 2 years in the options market that haven't been previously. That's the only way that this volume number could get to where it is, quite honestly. And what I really think about when I think about that is I really think about how vitally important education surrounding options is for all of those people that are getting involved in this market. I really hope that what we do at the OIC can really give you a broad-based understanding about how options work and help you to use them responsibly in your investing on a daily basis. So with that said, let's get right into the presentation. We have a lot to cover and a little bit of time to cover it in. First thing I'm going to do is give you a full overview of the Greeks and really what they are and how to kind of think about them as a concept. Then we're going to dive into each one individually: delta, gamma, theta, vega, and rho. Hopefully, again, we'll have time at the end for a little bit of a Q&A. Let's dive right in. An introduction to the Greeks. These are what we call the first order Greeks. They are really what option traders use to evaluate their positions and how sensitive those positions are to movement of the various pieces. Additionally, they are the language that option traders really use to speak to each other about risk. Some of the things that you might hear coming out of an options trader's pit. What is your delta? Meaning, how much delta do you have on? Remember, expected change in option value with respect to changing underlying price. That is your delta. How much gamma do you have on? That would be someone asking another person what their gamma position was. We'll get to gamma in a moment. That's the second derivative. Another thing you might hear is how much theta are you collecting or paying? Theta is time decay and how options respond to time over time. How much Vega do you have on there? That might be another question that someone would ask to get an idea of what kind of Vega position someone was carrying. That would be an expected change in option value with respect to implied volatility. These are all ways that option traders, and specifically professional option traders, really quantify their risk. And then it's a way that they're able to actually talk about risk with each other and be able to talk about how risk interacts on a daily basis. Now, the nature of the Greeks, this is a kind of a broad-based idea. Greeks are only meaningful during an option's lifetime. Once an option expires, the Greeks that are commensurate with that option become irrelevant. They also expire. Another way that these Greeks can go away is sometimes when you close an options position, those Greeks that would be associated with that position would also become irrelevant because you didn't have the options position on anymore. The only way that you have Greek exposure is if you have an active options position. Now, Greeks can affect each other. They can also be interdependent on each other. For example, in certain instances, options theta and delta can be linked together, particularly when you get very close to an option expiration. Also, the impact of a change in Greeks can be different depending on the type of option contract that is being affected. Take, for example, the difference between in the money, at the money, and out of the money options. They all have varying levels of different Greeks: delta, gamma, vega. And each one of those is going to be slightly more or less sensitive to changes in the underlying movement based on their particular Greek profile. So the other thing that you can think about is longer term options are always more sensitive to movement in implied volatility relative to their shorter term counterparts because they have more Vega in them. So we will talk to that concept of Vega later on in the presentation, but those are the things that you really need to think about when you're thinking about how these Greeks act and the nature of these metrics, because the Greeks are like kind of like a dashboard to your car, right? They give you an idea of what's going on without having to fully open up the hood and check the engine, right? Fuel, engine temperature, speed. They can tell you a lot about what is going on underneath the hood of your options position without necessarily having to open up the hood and take a look way down deep inside. So it's important to understand how these Greeks work and how they interact with each other, as well as how they work individually. Now, let's talk individually about delta, the first of these Greeks that we're going to dive into, delta and direction. I utilize delta and direction together because it's really hard to talk about one without the other, and this is why. Option delta, its definition, it is your option value sensitivity to stock price movement. In real world terms, it is the expected change of an option price up or down for each $1 move in the underlying stock price. So you can really think about options into three big buckets as far as their delta is concerned. Deep in the money options tend to have deltas tending towards 100. Now, deltas are expressed as a decimal, generally speaking. So 100 delta would be expressed as 1.00. In this case, deep in the money options have deltas approaching 100. What that means when you have a deep in the money option that has 100 delta is that its sensitivity to stock movement is basically 1 for 1. So if the stock were to go up $1 and you owned a 100 delta call, that call would also go up $1 in value because its delta is 1.00 or 100. The other bucket of deltas is considered at the money options, or deltas around those at the money options that have around a 50 delta. Now, calls and puts generally in the at the money space have close to a 50 delta, call delta being positive, put delta being negative. We'll get to that in a moment. But deltas of around 50 or 0.50 when it's expressed as a decimal are where the at the money options live. Now, generally speaking, right now in kind of the modern era of option trading and option modeling, even if you're looking at a stock that's a $50 stock and you're looking at the exact $50 strike, the call delta is probably going to be a little bit more than the put delta. Many times the call delta will have a 52 delta and the put delta will have a 48 delta. That is because of a concept called vol path or skew. It's a little bit of a second derivative kind of idea as far as the Greeks are concerned. I'm not going to take any deep dive into that today, but if you do have questions surrounding that concept, please make sure to send us an email and we will make sure to talk to you about vol path and skew and all of those wonderful things. We love to talk about that stuff. The third bucket of delta options is those far out of the money options. These are options that are 2, 3, 4, 5 standard deviations away from the at the money options. Their deltas are approaching 0 or 0.00 when it's expressed as a decimal form. Those are the options that are far out of the money and are far away from where the stock is trading currently. Now let's talk about delta characteristics and how calls and puts have different characteristics as far as their deltas are concerned. Calls have a positive correlation to underlying stock price change. Thus, they have what we term as long deltas. Now, being long a stock is a concept that lots of people can understand. It's a pretty ingrained in concept within the financial world. If you're long a stock and it goes up, you make money. If you're long a stock and it goes down, you lose money. Well, calls have positive or long deltas. They are in some ways seen as a proxy for being long the stock. They can act that way sometimes if it's the right call. But the really overarching idea that you need to have here is that they have a positive correlation to underlying stock price. So stock price goes up, generally speaking, your call price will go up. It has a positive correlation. When stock prices go down, the call prices generally go down as well. Again, positive correlation to the underlying stock price. Call deltas range from 0 to positive 100. Again, we have a positive delta here for calls. Now, puts conversely have negative or short deltas, and that's because they have a negative correlation to the underlying stock price, which means when the stock price goes up, generally speaking, your put price is going to go down. And when the stock price goes down, that put price is going to go up. Now, because puts have a negative correlation and thus a negative or short delta, their deltas range from 0 to 100, but they are expressed as a negative number. They have negative deltas. It's important that you remember the difference between calls having a positive correlation and puts having a negative correlation to underlying stock price. That's a building block of kind of knowledge that we're going to build on throughout this process of talking about the Greeks. Another way that people tend to think about delta is they use it to think about it in terms of its probability of an option finishing in the money. And so if you were to buy like a 70 delta call, some people think about it in terms of that option thus has a 70% chance of finishing in the money. Now, selling a 30 delta call could indicate a 70% chance of the option finishing out of the money. Now, this is a little bit confusing as far as the way that it's worded, but it's important that you understand generally when people think about it and characterize it this way, they think about it as the probability of the option finishing in the money. And so 70 delta calls, they think of as having a 70% chance of finishing in the money. And a 30 delta call, they would think of as having a 30% chance of finishing in the money and thus a 70% chance of finishing out of the money. Now, also important in this situation, in the money and out of the money does not equal profitability. This is a question we get a lot on the desk about why option trades necessarily don't necessarily make money because they're in the money or out of the money. It's not, you can create an option trade that is in the money that will lose money just as easily as you can use an out of the money option trade that will lose money as well. In the money versus out of the money does not equal profitability in either one of those situations. Let's have a really brief knowledge check here as far as how delta works. We're talking about a stock that is theoretically trading $100 with 45 days until expiration. This is a really crude kind of options montage or an options matrix here. These are your strike prices, and these are the resultant call deltas and put deltas for those strike prices. So we're trading $100 in this theoretical stock. This would be the at the money option. You can see the call delta is a 50 and the put delta is a 50. Let's look at some real world scenarios here. If an investor buys the 110 calls, these right here, the 110 calls for $1, what is the expected option value if shares increase to 105? Well, we're starting at 100 and we're talking about the stock going up to 105. That's $5 of movement. Remember, delta is the expected change in your option value per $1 movement. So if you're talking about $5 of movement, you need to multiply your call delta by 5 to get how much you would expect it to move for a $5 move up, and then add it to the value that you started with. So 5 times 20 cents, that gives you $1. You're going to add that to your original dollar, and you're going to get $2. That's what you should think about it being worth. It's an estimated value. It assumes that all other factors are remaining constant. Obviously, there's a lot of factors that go into option pricing, and they're dynamic. And so you can't really drill down that specifically into it, but this is a good kind of benchmark for what you should be thinking about. Another question, if an investor sells 2 of the 90 strike puts, what is the estimated probability that the contracts will finish out of the money? The 90 strike puts are right here. The put delta is a 15 delta. Remember, when people think about delta as a proxy for a percentage chance of finishing, they think about it as finishing in the money. So in this case, it would have a 15% chance of finishing in the money and thus an 85% chance of finishing out of the money? And that's the answer to that question. Third question, if an investor buys the 100-110 call spread for $3.20, what is the expected value of the spread if the shares increase to 105? Let's take a really brief look at this. The 100-110 call spread, for those who aren't initiated into the spread terminology, that would mean if you were buying it, you'd be long the 100 calls that have a 50 delta. You would be short the 110 calls that have a 20 delta. In order to get the resultant spread delta here, you need to net out these deltas, because one of them is going to be positive, the one you're long, 50, and one of them is going to be negative, the one you're short, 20. And so your call spread should have a resultant net 30 long delta. And what is the expected value of the spread if we increase it up to $105 in the underlying? Well, that's another $5 move. We've talked about the spread having a 30 delta. 5 times 0.3 is going to be 1.5. You add that, $1.50 to your original $3.20, and you get $4.70. So this is a really good way to kind of check and make sure you have a real world grasp of how delta works. That's our first Greek that we're going to examine. Now we're going to move on to gamma. Gamma is the second derivative, and it is the delta's sensitivity to stock price. Now, keep in mind, delta was the sensitivity of the option to a $1 move in underlying price. Gamma is the actual sensitivity of the delta to a $1 move in underlying price. This can be somewhat confusing for people who are just starting out, but this is why it's considered the second derivative. Now, all other pricing factors remaining constant, gamma is expressed again as a decimal, just like delta is, and it is really thought of as kind of an adjustment to delta. It's how much your delta is going to move. How much is your delta of the options that you're either long or short going to change when the stock moves by $1 one direction or another? Now, there are 3 things that I want you to remember about gamma. If you remember anything about gamma, I need you to remember these 3 things. The first thing is the definition that we just gave you. The anticipated change in the delta value of an option for a $1 move in the underlying stock. It's the change in your delta. Only options have gamma, okay? The second thing I want you to remember is gamma is most highly concentrated in at-the-money options because of their sensitivity to underlying movement. I'm going to say that again. Gamma is most highly concentrated in at-the-money options, and that is because of their sensitivity to underlying movement. Consider this. A $1 move in the underlying is going to affect the at-the-money option that has a 50 delta much more than its out-of-the-money counterpart with a 10 delta. That is gamma, and that is where it is most highly concentrated. It is in at-the-money options versus out-of-the-money options. The third thing you need to remember is long-term versus short-term. Gamma is most concentrated in short-term options. They are the most sensitive to movement in the underlying because their gamma is the highest. The farther you go out on the duration curve, the less gamma your options are going to have. If you're trading a 2-day option, it's going to be exceptionally high in gamma. If you're trading a 200-day option, it's going to be much lower in gamma, but it's going to have a significant amount of Vega in it. Now, we will talk about that in a moment, but let's talk about gamma characteristics for calls and for puts. This is where things get a little bit interesting. I think about gamma as the amount of the potential change in an option delta. And thus, if you think about Brownian motion and a random price distribution that theoretically that the equity market has, gamma should be equal for options that give you the exposure to the upside and the downside movement. So puts and calls. Puts give you exposure to the downside, calls give you exposure to the upside. But if they have the same strike, because of the fact that we think of price as a random walk or a Brownian motion function, gamma is going to be the same for puts and calls when they're on the same strike. Now, keep in mind, calls have positive correlation to underlying price and puts have negative correlation to underlying price. Thus, gamma for calls work this way. When the stock price goes up, your delta of your option should move up by your commensurate gamma amount. And when the stock price moves down, the delta of your option should move down by your commensurate gamma amount. This is pretty simple to understand, right? It's a positive correlation. Things get a little bit more convoluted when you're talking about gamma for puts. Puts have a negative correlation to underlying movement. So when stock price goes up, your delta of those options is going to move down by your gamma amount. And when stock prices go down, the delta of these options is going to move up theoretically by this gamma amount. Now, gamma is what option buyers are paying for when they buy options. They're really looking for the net possibility of this option to change its value over time. It's going to be something that is really important when you're starting to get close to expiration. Gamma starts to really spike, but it's a concept that people use when they're talking about how options move and what those options do when the underlying moves. I like to think about it as the potential energy that's embedded in these options. It's the potential for these options to move. It's the way that the delta moves when the underlying moves. It's always expressed as a positive number when we're talking about options in general. Gamma is. Now, the important thing to think about here is that a lot of people would interject and say, well, I always hear about these negative gamma squeezes. How is it possible to have gamma always be a positive number and have all these people be negative gamma? Well, the gamma of the option itself is always expressed as positive. It is what you do with that option that creates an either positive or a negative gamma position or gamma exposure of your position. The options themselves always have a positive gamma because it's really their potential energy that we're measuring with this metric. So you can get negative gamma by selling a bunch of options. You can also get positive gamma by buying a bunch of options. Now, keep in mind, gamma is also most concentrated, again, around short-term options because of this next slide. The next slide is going to give you an idea of gamma over time, because gamma doesn't always stay constant. As expiration nears, gamma of at-the-money calls and puts increases, and in some cases it increases exponentially as you get super close to expiration. Gamma of both in the money and out of the money calls and puts decreases as you get close to expiration. What we have here is kind of a crude graph that gives you an idea of what these different gamma distributions look like with respect to the duration of these options. So if we're talking about this stock trading $60 and it has a 30 implied vol and a 2% interest rate, the $60 option on these different durations has significantly different gamma profiles. This is your 1 month option. It obviously is going to have the highest gamma out of these. It has almost an 8 gamma. Your 3 month option has just over a 4 gamma. That's a little bit less than half. Your 6 month option has about a 3 gamma, and your 18 month option has about a 1.5 gamma. Now, this is all for the same strike price. The only thing that's different amongst these options is their duration. Like I said at the beginning, the longer dated options have less gamma and more Vega. The shorter dated options have the most gamma and they have significantly less Vega in them. Now let's talk about a little bit, let's have a little knowledge check as far as gamma is concerned. If an investor were to buy the 50 calls and the shares increase $2, what is the new expected delta? So we're talking about shares trading $50 and we have about 10 days till expiration. If we bought the 50 calls and the shares went up $2, what's our new delta? Well, the 50 calls start with a call delta of 51. But their change in delta, their gamma, is a 12. And if we're talking about the stock going up $2, we're going to need to take this 12 gamma and multiply it by 2 to get 24. Add 24 to their original call delta of 51, and bang. Their new delta after the move would be a 75 delta. Another question, if an investor were short the 50 calls with the stock trading 50, so the exact at the money option, would a share price increase to 52 result in an increase or a decrease in gamma? To answer this question, you need to remember that options that are at the money have the highest gamma out of all of the options on the board. So if you're starting with owning the exact, or sorry, if you're starting with being short the exact at the money call, any move away from the at the money price, either up or down, would result in a decrease in the gamma of that option. Third question, if a trader were long 10 of the 52 calls and they were delta neutral, meaning they had sold the commensurate amount of stock against them, and shares increased from 50 to 51, how many extra shares would they need to buy or sell in order to remain delta neutral? Well, let's talk about it. If you're long 10 of the 52 calls, your call delta for each one of those calls is 29. If you're long 10 of them, you need to be short 290 shares of stock in order to be delta neutral for that position, for 10 of them. Now, this call has a gamma of 10, meaning if the stock moves from 50 to 51, this 29 delta is going to, you guessed it, 39, and you have 10 of them, so you would need 390 shares of stock in order to be delta neutral. So you've already got 290 shares. You would need to sell an additional 100 shares of stock to get you delta neutral or being short 390 total shares of stock. Again, 3 things to remember about gamma. I want you to remember the definition. It is the anticipated change in the delta value of an option for a $1 move in the underlying stock. The second thing you need to remember, gamma is most highly concentrated in at the money options. Remember, a $1 move in the underlying affects the at the money option, the 50 delta option, much more than its out of the money 10 delta cousin, right? Long-term versus short-term, gamma is most concentrated in the short-term options. They are most sensitive to movement in the underlying, and the reason why is because they have the most gamma. Those are the 3 things I want you to remember about gamma no matter what, because they are very important. Let's move on to theta. Theta is time decay. It is option values sensitivity to time. The actual definition here is really the expected time decay in your option value. If you fast forward the day 24 hours to tomorrow's exact time at this time tomorrow, 24 hours later, your option should theoretically move by their commensurate theta. Each option has its own theta. Each strike has its own theta. It's expressed in a decimal form again. So in this case, this is what we would call 8 cents of theta. Decay is calculated per calendar day. This is very, very important. We get a ton of questions about this. Decay is calculated per calendar day, not per trading day. It doesn't matter if it's the weekend. It doesn't matter if the exchange is open or not. It doesn't matter if the stock is halted or it's a holiday. Theta comes out per calendar day, not per trading day. So it happens over the weekend, just like it happens on the trading day. It represents a cash amount per option. And again, all other pricing factors remaining constant. This is something we always have to say because it's important to think about these things in their own little kind of universe to begin with. Calls and puts both have negative theta amounts. What this means is that options are generally decaying, always decaying. That is basically what theta is really representing. It is a function of optionality because options are for a specific period of time. You need to factor in the idea that as each iteration comes out, as each day comes out, and that price settle comes out of that group of iterations that are possible, theta has to come out commensurately with it. there are a lot of factors that can counteract that decay happening on a daily basis. The first is movement, underlying movement. When stocks are moving a lot, it's really hard to forecast exactly what an option will be worth. And thus, it's hard to remove theta from the options on a daily basis because there's not a lot of people that really want to sell options in those situations. In a situation like this, you could see implied volatility levels rising and thus counteracting the forces of theta more generally. So what you would see in that case is your theta is actually coming out of the options. It's just that if implied vol is going up more, then you're going to see those options actually potentially going up in value instead of down in value, because the amount that you're pumping into those options through implied volatility is actually overcoming the amount of theta that's coming out on a daily basis. Let's look at a real world example of theta and time decay. For an option that's trading $3.50, it has a theta of 3 cents. This is what we would call that, 3 cents of theta. On today's date, this contract is worth $3.50 times its underlying multiplier of 100 shares, or $350 in notional value. Now, when you're doing notional calculations with respect to equity options, which are generally American-style options in the United States, you need to understand that these prices, this $3.50 price for the option, is priced in per share dollar terms. And each one of these options is generally able to, the contract multiplier for each one of these options is generally 100 shares of stock. So when you're trading a one lot of options, you're actually trading the right to control 100 shares of stock. That's where the concept of leverage comes into the option world, and why people talk about options as such levered vehicles, because of this multiplier. So when you're doing these notional calculations, $3.50 has to be multiplied by 100 shares, which is the underlying multiplier, to get you to $350, which is your notional value. Now, let's talk about how that notional value changes when we fast forward one day and take that 3 cents of theta out of its value. $3.50 is where we start. We take our 3 cents of theta out. That gets you to $3.40. That might be what the option would be worth tomorrow. So now your contract's worth $3.47. Again, you do the notional math here times 100 shares. It's worth $347. Your theta of 3 cents is a $3 loss per contract in value. Now, some people like to look out in farther blocks of time in order to calculate what they think these options might be worth. Lots of people will look 10 days from now. They'll look at what it's worth on this day next week. Now, as you get into that process of trying to get expected value for a 10-day move in theta, you need to understand that theta is not always linear. And you can look at this and say, well, this has 3 cents of theta, and 10 days from now, it should be worth 30 cents less than it is now. And you might be right, but you might be drastically wrong also. There's a lot of dynamic factors that are being built into this. The stock could move, the implied volatility could move, the skew could move, interest rates could move, all kinds of things could move. Skew could move, kurtosis could move, all kinds of things could move between now and then. But a lot of people do this math and try to think about what it might be worth 7 or 10 days from now. It's not a bad thing to do. It's just that you need to understand that theta is not always linear, and it doesn't come out perfectly on every single day. And the next slide is going to give you an idea of the curvature of theta. So time decay is not always linear, like I said. This graph gives you an idea. This is how much the option is worth in time value on this axis. This is time passing. And let's assume that this is right here, your expiration date. So we're going this direction towards expiration. This is what your at the money decay looks like over time as you approach expiration. The overall rate of time decay is exponential for at the money options. It accelerates towards expiry. Now, in the money options have a much more linear time decay because they don't have as much extrinsic value for them to come out. Consider a 100-day option. Let's say this is a 100-day option here. And you're removing 1 day of theta, and thus 1 day of price iteration of the underlying from its value. that doesn't comprise a significant portion of that option's value or of the iterations that are contained within that option. Now, contrast that with an option that has only 5 days to expiration. We're right here. And thus only 5 iterations of price settlement left for the underlying encompassed within that option. Removing 1 day of theta and 1 day of an iteration from that timeline of this option comprises a significant portion of its value. And thus the theta that comes out will be commensurate with that percentage of the value that you're removing. That's why this decay starts to have curvature as you get close to expiration. It starts to go exponential here for specifically at the money options as you get close to expiration. Let's have a knowledge check here on theta. If you are long the 95.90 put spread for 50 cents, does theta help or hurt your position? What you need to remember here is that your long optionality, you paid money for this thing and your long optionality. What that means is it doesn't really matter what put spread this is. If you're long extrinsic value, theta is going to hurt your position if you are long extrinsic value. Theta is how much this option is going to be worth tomorrow, how much less it's going to be worth tomorrow. It decays on a daily basis. Now, long the 80 strike calls for 2025 or long the 85 strike puts for 40 cents, which is more affected by time decay? In this situation, with the shares trading $100, this 80 strike call is $20 in the money. The 85 strike put is $15 out of the money. Which is more affected by time decay? Well, the 85 strike put is going to be more affected by time decay because all of its value is extrinsic value, whereas the 80 strike call has a ton of intrinsic value built into it. $20 to be exact of intrinsic value because the stock's trading $100. Remember, that intrinsic value has a much more linear time decay than the extrinsic value of the at the money or the out of the money options. Last one. Stock is trading 50 and you are long the April 50, March 50 calendar spread. Does theta help or hurt you? First and foremost, let me explain to people that don't understand this. This is a calendar spread. It means that if you're long the calendar spread, you are long time, meaning you're long the March, the longer dated option, and you're short the April, the shorter dated option. So in this case, you need to think about which one of these options is decaying faster. And the answer is the April is decaying faster. And since you are short the April, theta is going to help this position. That spread is going to be worth more on a daily basis because this April 50 call is going to decay at a greater rate than the March 50 call will. Now, remember, theta comes out on a daily basis. It can sometimes be replaced by elements like movement or resultant delta that comes from that movement or implied volatility. But the theoretical theta function exists every single calendar day. It is not based on whether the exchange is open or whether your stock is open or whether your index is open. It comes out on a daily basis. The other thing you need to remember about theta, it's greatest in at the money options, and it increases exponentially toward expiration. Remember the concept of the curvature of the at the money versus the in the money options and their respective decay functions. One of them, the at the money option, has curvature as you get close to expiration, and the other one is linear or almost linear in nature. That's those in the money options. The deep in the money options have almost a perfectly linear decay function. Now let's talk about implied volatility and Vega. Vega is the volatility Greek. Its technical definition is an option value's sensitivity to volatility. Its real world definition is how much you should expect your option to change in value with a 1-point change in implied volatility. It's expressed in decimal form, much like all the rest of the Greeks, and it represents a cash amount per option. Now, again, all other pricing factors remaining constant here. It represents a cash amount per option because when you look at something like this, let's assume you have a $3 option. And it's trading on a 20 implied vol, and you move the vol from 20 up to 21. in this situation with 8 cents of theta, you can expect that $3 option with a 1% move up in implied volatility to be worth 3.08 once you move it up. And then if you were to move it up another percent, it would be worth 3.16. And then, of course, 3.24, right? Now, implied volatility doesn't always move by 1% increments. And I think most people that have been trading options in the current environment can tell you that increments of change in implied volatility can be very large. We have a calculator on the OIC website that's a great tool that can help you to forecast how things will move depending on how the Vega of the option is moving. I really recommend you check it out. It's at optionseducation.org. It's pretty prominently placed on there. Lots of people use it. And I'll tell you, on the investor education desk, a lot of the time if that tool goes down, that's when we get the most emails about what's going on. People use that thing constantly. It's a really great tool, and I highly recommend you use it. Now, calls and puts both have positive Vega amounts. Much like gamma, Vega is expressed as a positive number. It is what you do with these options that can create your positive or negative Vega position. You can be short or long Vega, even though it's expressed as a positive number. If all you do is sell options, guess what? You are short Vega. Even if you don't think you're short Vega, you're short Vega. The amount of Vega that you're short depends on the duration of the option you are selling, because options that are longer dated in duration have more Vega. And if they're shorter dated, they have less Vega. Now, conversely, if all you're doing is buying options, you are long Vega. And again, duration will speak to how much Vega you are long. But if your entire options position is comprised of just long options, you are theoretically long Vega. And your P&L will show that as implied volatility moves up and down. One of the most important things that I said there, the longer the duration of the option, the more Vega it will have. The shorter of that duration of that option, the less Vega it will have. Now, if you think about Vega in terms of time, it is actually the exact opposite of gamma in terms of time. Longer duration options have lots of Vega and very little gamma, and very short-term options have lots of gamma and very little Vega. Let's talk about historical and delivered volatility. There's two main types of measured volatility. We're going to talk about both of them here. Historical or delivered vol and implied vol. What you're looking at here is a graph, a kind of a crude graph of stock price over time, with today being this dotted line. The way that I kind of bisect volatility as far as this is concerned is I think what has happened already constitutes historical volatility. You can measure it. It can be quantified, observed. It's historical. It's a statistic or a fact. It is backward looking, and it's not a prediction. It is something that you can go back and look at as an investor. You can customize the term of delivered volatility that you want to look at. When I was trading, I would go back and I would look at 10-day delivered vol, 20-day delivered vol, 50-day delivered vol, and 100-day delivered vol. And I would contrast those against each other to kind of build a picture of what the volatility of this underlying looked like over the last 100 days. Maybe it was really volatile for the last 10 days, but for the 100 days, it didn't move at all, really. And so it lets you look at what some of the price distributions could look like in smaller terms as far as those customized terms of historical vol for those day vols that are important. The interesting thing here is that once you get to today, we start to make the switch from historical volatility, which can be observed, quantified. You can put it into an Excel document and look at it. Now you move into implied volatility. Implied volatility is the best guess of the marketplace for how much this underlying is going to continue to deliver over time. We will talk about implied volatility in a second, but what you really need to think about here is delivered volatility. Historical volatility is what has happened in the past, and implied volatility is a forecast or a forward-looking metric for how people think about what these options are going to be worth in the future. It is also implied volatility, one of the main pricing inputs for option modeling that we use. Let's compare some distributions of these stocks that have different historical volatility profiles. These are 3 different price distributions. So stock A has a 15% historic volatility, stock B has a 25, and stock C has a 35. As you can see, we're talking about a $100 mean here, and this is just standard deviations away from the mean as far as price settles are concerned. When you cram the same amount of iterations into a smaller area surrounding the mean, which is what happens when you get these low historic volatility stocks, what you end up with as far as price distribution is concerned is a narrow distribution from here to here with a lot of amplitude. The reason why is because you're cramming all of these iterations right around the mean. It might trade 99, and then it might trade 101, and then it might trade 98, and then it might trade 101 again. All of these iterations of price are right in here in this mean. As vol levels increase, those distributions start to look more flat. And the reason why is because you end up tending towards a straight line as each one of those price settles becomes equally more likely when vols start to increase. If you take a look at the 25 vol, it has a little bit of a flatter distribution because you're taking all of those same iterations and you're spreading them out. It's a more volatile stock. It's moving around a little bit more. It's settling over here. It might settle 90 one day, and then it might settle 110. Each one of these prices starts to become equally as likely. Now you move into stock C, and you've got a 35 historic vol. It's delivering a 35. It's starting to look a little bit more and more and more flat. Each price along the axis becomes equally as likely, and thus the distribution starts to look more flat. As volatility in general, historic volatility, tends towards infinity, these distributions will start to look like a flat line. I generally use the example of 2008. I was trading index options in 2008. If I walked into work in the morning and you told me that the index that I was trading was going to settle 7 standard deviations away from where it was right now, I would have looked at you and said, okay, yeah, sure, that's possible. It happened yesterday. And it becomes one of those things where if you don't have a good idea of where this thing is going to settle, each one of these prices becomes equally as likely. And as each one of those prices becomes equally as likely, you tend towards having a straight line for the price distribution. This really introduces the concept of implied volatility and how it affects options pricing, because as historical vol starts to move up, sometimes we get commensurate moves in implied volatility that are corresponding to those. Now, option implied volatility. This is what I was talking about before. It's a huge part of how we create option valuation. It's a really big input into the pricing model. It's a volatility level that can influence the options price. It can be determined via an option pricing model or the calculator like we use on the OIC website. It reflects the underlying volatility expected by the marketplace. Like I said, it's a forward-looking metric. Historic vol is what has happened in the past. Implied vol is the market's best guess as to what's going to happen in the future. Now, who makes or determines these market prices as far as implied vol? And the answer is everyone who is in there trading options, making bid and ask prices and trading options, is helping to kind of crowdsource that implied volatility level. And the reason why is that every time an option trades and changes hands, there is a commensurate implied volatility level that is reflected by the price of that option trading. So professionals and individual investors alike, anyone who's in there trading is creating vol levels on a minute-by-minute basis. let's cover implied volatility and how it affects directly option prices. A change in underlying stocks' historic vol may or may not affect the option market price. So what I just said before is that a lot of times when you see something that has a really high historic or a delivered vol, that you'll see a commensurate move in implied volatility. That doesn't always happen. They're not inextricably linked, but occasionally things will diverge from that. But generally speaking, those things tend to kind of move in the same orbit, let's say. Other pricing factors remaining constant, a change in implied volatility will affect option prices in this way. As implied volatility increases, both calls and puts will increase in price. And as implied volatility decreases, both calls and puts will decrease in price. These are positively correlated. Implied volatility and price is positively correlated. Now, it's always important to talk about the fact that implied volatility is a really dynamic part of an option price, and it's moving constantly. And like I said, you can't really think about option implied volatility as moving 1% at a time, because that's not really how it moves. The Vega of an option is its sensitivity to a 1% move in the implied volatility, but it doesn't really move that way. It's constantly moving in increments, sometimes much larger than 1%. Sometimes it's moving in 10% increments. It moves around all the time. Let's take a look at an implied volatility level in action and how this would work. So we're talking about a $100 stock pre-earnings. They have not released earnings yet. Stock's trading $100. There's 13 days to expiration, and the implied vol is a 50. This 105 call is worth $1.85, and these are its Greeks. 30 delta, it's got 5 gamma, 15 cents of theta, 10 cents of Vega, and 1 paltry penny of rho. Now, let's assume that the stock releases earnings and we fast forward 7 days. Let's take a look at what happens to this call value. The stock is up $5. Now, if you look at this 105 call, a lot of people are going to look at this and say, why did the call go down in value? Well, there's a couple of factors at play here. The stock moved up $5. The delta of the call moved up by 20. The gamma increased because now you are trading the exact at the money option. The theta also increased. The Vega went down and the rho stayed the same. Here's the thing that you really need to pay attention to. We're talking about 7 days later. It is post earnings, meaning what was unknown before is now known in this scenario. And this is the big guy right here. The implied vol went from a 50 to a 30. Even with a $5 increase in the share price, these calls lost value due to time decay, theta, and decreasing implied volatility. Let's have a little knowledge check on vol and Vega. With a 100 strike call, is Vega greater on the contract expiring in 5 days, 30 days, or 90 days? Remember, gamma, most concentrated in short-term options. Vega, most concentrated in long-term options. The 90-day option has the most Vega out of those three, 5, 30, or 90 days. An investor's putting on a covered call strategy. Do they have a long or short Vega position? And will an increase in Vega help or hurt their trade? A covered call position, for those who don't know, is selling an out-of-the-money call, an at-the-money or an out-of-the-money call against an already existing long stock position. So the thing that you need to understand here is that you are short options. If you're selling covered calls, you're short options. And if you're short options, you're short Vega. And if you're short Vega and vol goes up, you're going to get hurt on that trade. An increase in vol will hurt your trade because you're short Vega. If stock drops 15% as a result of unexpected company news, are long or short Vega positions likely to be positively impacted? Generally speaking, unexpected company news and large moves in the underlying like this, 15% moves, that's probably a 10 standard deviation move, depending on what the vol is. If something moves that much, long options are generally a better bet to have on in this situation. They are usually going to go up in value because implied volatility is probably going to go up in value in this case. It's an unexpected move. It's a 15% move to the downside. I'm going to say there's a pretty good chance that the vol is going to go up. So long options here. Now, let's talk about Rho and interest rates. Rho is kind of the redheaded stepchild of the Greek world. Rho is an option value sensitivity to interest rates. Now, why is it the redheaded stepchild of the Greek world? When is the last time that we saw interest rates and the risk-free rate move by a significant amount? And the answer is a long time ago. Options and Rho in options have been kind of not a factor as far as trading is concerned for quite a long time because interest rates have been very close to zero for a very long time. Rho is the expected change in the option value with a 1% change in the risk-free rate. It's expressed in decimal form, much like the other Greeks. It represents a cash amount per option, also like many of the other Greeks, all other pricing factors remaining constant. It's considered, like I said, the least significant of all the pricing factors. Part of that is because we're in a very low interest rate market and the interest rates haven't moved very much. This is a component of the cost of carry. So an old saying that people used to say on the floor is that the carry is in the call and the premium is in the put. What that means is that when Rho moves, it's going to affect your calls. When Rho increases, when rates increase, calls are going to increase and puts decrease. And when rates decrease, calls are going to decrease and puts increase. The reason why is because, and also Rho is really most focused in the money and longer dated options. And the reason why is because those options are the really big options. What you're really doing when you're trading option premium like that is you're trading big blocks of premium and you're investing a significant portion of money into those things. And so a move in interest rates is going to affect your big blocks of premium through Rho, because let's say you have 1,000 lot of calls and you have $300,000 invested in these calls. The interest rate moving is going to affect that amount of money. Now, if you want to understand how your options position is moving and thus how your P&L will be affected, it is really imperative that you understand the option Greeks. Educating yourself about how these metrics move individually, as well as how they're interconnected and can move in concert, will help you diagnose problems with your positions and more effectively manage your real risk going forward. When you break down how these Greeks affect option prices individually, it can almost become second nature to really be able to read an options position and understand what its inherent risks are based on just a few metrics across the top of the page and along the price curve. I hope that some of the information that I presented today can kind of jumpstart your understanding as far as how these Greeks work. And I hope that we can continue to educate you as to how you can utilize these metrics to more responsibly use options in your investing on a daily basis. Please don't forget to send us emails at options@theocc.com for any questions that you have surrounding options. And don't forget to check out optionseducation.org. It is a fantastic website that has a lot of educational resources there. We spend a lot of time putting together that stuff, and it really, I think, speaks to how much of a really vital part of the options ecosystem we think that the education should be. Don't forget also, April 13th is our next webinar, which should be the poor man's covered call done by our friend Roma. And thank you to Mark and Ken so much for doing the Q&A in the background. I think I'm probably over on time. But I guess we could answer a couple of questions if we had any time. Mark, what do you think?
Yeah, Matt, we're certainly in no hurry to go anywhere. Ken and I have been behind the scenes answering the questions as they come in, several dozen responses we provided. I do want to address just one minor point, and then I want you, if you would, to address something as well. We've got a lot of questions coming in where people are asking for additional books or resources that they can learn about the Greeks. Unfortunately, we are prohibited from making any specific recommendations, so we would be unable to give you a book title or a website, something like that. Our advice or our recommendation would be simply to do a Google search. Matt, and this is going to be completely off the topic, so to the audience, I apologize. But Matt, as you know, there's been a lot coming across our desk in terms of trading halts. And for those in the audience that might have options on one of these securities that have been halted, I was wondering if you can maybe just take a minute or two and explain to people how the process works and what they can expect in that event.
Absolutely. Yeah, thanks for bringing that up. It's a very timely thing to talk about, obviously. There's been a lot of, especially with the Russian and Ukraine situation, a lot of stocks and ETFs recently that have been halted. We've been answering a lot of questions about a lot of specific names. But what you really need to know about, generally speaking, is that when options and stocks, when the underlyings are halted, it's really the decision of the exchanges to halt those stocks. And once you halt a stock, the options themselves that are associated with that stock also become halted. Now, the hard part about this is that when you look at that situation, you are limited in your options, to use a phrase. You're limited in what your options are as far as getting out of your trade, because most of the time when stocks halt like that, the options halt and there's just no market for them. Now, when exchanges halt those underlyings and the associated options, the OCC does not preclude, a halt does not preclude people from actually exercising their options, and also possibly from people who are short options from being assigned on those options. So we at the OCC try to do the best job that we can in trying to give the public as much information as we have as soon as we can through our information memos at the OCC website. You can find those, and what you can do there is you can do a search for whatever underlying you're looking for, and corporate actions such as this, they're always handled on a case-by-case basis. And so we get a ton of questions about how are these options going to be settled if the stock doesn't reopen before expiration. And the answer to that question is it's determined on a case-by-case basis, and it's very hard for us to comment on how those things actually work. But in some cases, for instance, if you were long puts in something like this that was looking like it might be delisted, sometimes your brokerage firm, and not the OCC, will put a limitation on whether or not you can exercise your puts, depending on whether or not you actually own the physical underlying to deliver when you exercise those puts. Now, they do that for operational risk reasons. They have to cover their own operational risks. And so what we're seeing sometimes in this situation is that they're limiting, the brokerage firms themselves are limiting people's actual availability to exercise their options. What that does, unfortunately, is it leaves people in a little bit of limbo as to whether or not they can or want to, in that case, exercise their options. And so unfortunately, what ends up happening is that people have to make their own decisions about what they think this stock or underlying or ETF is going to be worth, and then make that decision and communicate that to their brokerage firm as to whether or not they want to exercise their options or not. Again, the OCC hasn't put any limitations on whether or not people can continue to exercise options, and so it becomes a little bit of a gray area. It's something that doesn't happen very often, but right now the way that we're handling it is we're making sure that people understand that much of the limitations in this situation come from their brokerage firm specifically, and that they should reach out directly to their brokerage firm because each brokerage firm handles it slightly differently. So it's important to understand those limitations as well.
Well, that's great, Matt. Thanks. I appreciate that. Go ahead and wrap it up. Great job today, by the way.
Oh, thanks. Thanks. I really appreciate it. I hope that some of the information that I put forth today as far as the Greeks are concerned can help you guys in your investing on an everyday basis. Please don't forget, visit us at optionseducation.org. Send us emails at options@the-OCC. Remember, we will answer your emails. You'll get a real human response from a real person with real trading experience. We can't give you directed investment advice because we're not registered advisors, but we love to talk about options and we love to talk about optionality. April 13th is the Poor Man's Covered Call with Roma. She's going to be doing the next OIC webinar that will start April 13th. That'll be the first one of our second quarter. And I wanted to make sure I said thank you to Mark and Ken for doing the Q&A. I hope you guys enjoyed it. And that is all we have today. Thanks a lot for coming.